There's a tax election that lets a YouTube creator earning $200,000 a year legally keep an extra $23,000, money they're currently handing to the IRS for absolutely no reason, and their own accountant might never bring it up. It's called an S-corporation election. The financial advisor industry built its entire fee structure around you not knowing this move exists. Most content creators think taxes are simple. You made money. You pay taxes. Maybe you write off a camera, a microphone, a ring light. Done. But if you're running a channel, even earning $10,000 or $20,000 a year, the IRS classifies you as a self-employed business owner. And that classification comes with a tax bill nobody warned you about. As a sole proprietor, you're paying a 15.3% self-employment tax on every single dollar of profit. That's before your income tax even touches it. You're getting taxed twice on the same money, and the people who could have told you that didn't because you never asked. The mechanism is called an S-Corp election, and here's what it isn't. It's not a new company, not a complicated restructuring, not something that costs $10,000 in legal fees. It's a tax classification change. One form filed with the IRS, Form 2553, that tells them to treat your existing business as an S-corporation for tax purposes. Here's why that single filing matters. As a sole proprietor, the IRS treats 100% of your business profit as personal earnings. Self-employment tax, Social Security, and Medicare combined hits all of it at 15.3%. Under an S-corp structure, you split that income into two buckets: a salary you pay yourself, and owner distributions. Self-employment tax only applies to the salary. The distributions flow to you clean. That's the whole mechanism. Here's the worked example so the number becomes real. Say your channel pulls $200,000 in net profit this year. As a sole proprietor, you're paying 15.3% on roughly the first $160,000. That's $24,500, plus 2.9% Medicare on the remaining $40,000. Total self-employment tax, close to $26,000, just for existing as a creator. Now elect S-Corp status. Your accountant sets your salary at $80,000, a reasonable compensation for what you actually do. Social Security and Medicare apply to that $80,000. That's $12,240. The remaining $120,000 comes to you as a distribution. No self-employment tax. Your SC bill just dropped from $26,000 to $12,240. That's $13,760 saved every single year. And this isn't even the best part. Layer a solo $401k onto that S-Corp structure. As both the employee and the employer of your own S-Corp, you can contribute up to $69,000 per year into a solo 401k. At a 24% income tax bracket, that's another $16,500 in taxes, deferred money that compounds inside a retirement account instead of disappearing into the federal budget. One structure change, two moves. You've redirected over $30,000 annually from the IRS directly into your own account. This is exactly what established creators with real accountants have been doing quietly for years. But here's where it gets interesting. The reason you've never heard this spelled out isn't that it's hidden in some offshore vault or reserved for people with 100 million subscribers. It's that the W-2 world, the world of regular jobs and employer benefits, never had reason to teach it. Banks profit from the accounts where you stash your quarterly estimated taxes. Tax software companies profit from the exact complexity that makes you think you need them, not a structural conversation. And a generalist accountant who does returns for dentists and realtors may simply have never set up an S-Corp for a creator before. Now the caveat, and it matters. The IRS has blessed this structure for decades, but they've also written the rules clearly. You cannot pay yourself $1 salary to wipe out all self-employment taxes. The IRS requires what they call reasonable compensation, what you pay someone else to do the same work. For most creators, that number falls between $50,000 and $100,000 depending on your niche, your output volume, and your revenue. Said it right, Run payroll quarterly through a processor, and this structure is airtight. The IRS doesn't oppose this move. They wrote the rule that enables it. Go back to that opening number, $23,000 a year. Over 5 years, conservatively, that's over $115,000, not lost to bad investments or market swings, just handed to the IRS because no one handed you this file. The election is available to you today. You don't need 1 million subscribers, a team, or a media company. You need self-employment income and one conversation with a CPA who actually works with creators. But there's a related structure that takes this one level further. The people who use it are sheltering a number north of $300,000 per year entirely from ordinary income tax, and it doesn't require a channel at all. That's the next file.